I was watching the spot price tick higher when my phone exploded with panic calls that would forever change how I understood commodity markets. December 11th, 2025, 9:47 a.m. Eastern Time. The exact moment when the global silver supply chain snapped like an over-tightened guitar string under pressure that had been building for months. The price on my Bloomberg terminal showed $62.30, a number that should have triggered champagne celebrations in precious metals dealer offices worldwide. Instead, it marked the precise coordinate where the entire distribution system that had moved silver from mines to customers for over a century collapsed into absolute chaos. The first call came from Marcus at Delaware Precious Metals, his voice cracking with stress I had never heard despite 15 years of business relationships that had survived every major financial crisis since 2008. "We've suspended all sales effective immediately," he said without any greeting or preamble, speaking rapidly as if reading from a disaster response checklist. "Websites down, phone lines are shut off, retail operations are completely halted until further notice." Before I could ask what had triggered such drastic measures, he continued with the desperation of a man watching his life's work disintegrate in real time. "Our hedging line with Scotia just got margin called for $12 million. We literally cannot replace what we sell. Every ounce we move to customers comes out of our strategic reserves that we can't restock." The second call arrived before I could process the first. Sarah from Monument Metals in DC, normally unflappable, sounded like she was reading from a disaster script. "All inventory frozen. We've got 300,000 ounces of retail orders from yesterday that we can't fulfill. Our wholesaler in Switzerland just canceled our delivery scheduled for tomorrow morning." By 10:15 a.m., I had received identical reports from 17 different precious metals dealers across North America and Europe. The pattern was unmistakable and terrifying. Every major distributor was simultaneously experiencing the same crisis. They had silver to sell, customers desperate to buy, and prices at historic highs, yet business had ground to a complete halt. I realized I was witnessing something that financial textbooks claimed was impossible, a market where infinite demand met zero supply at rising prices. The fundamental mechanics of commodity distribution, perfected over centuries of global trade, were failing in real time while I watched helplessly from my trading desk. The root of the catastrophe traced back to a hedging system that had worked flawlessly for decades until silver prices began moving like a manic cryptocurrency rather than a stable industrial commodity. Every precious metals refiner and wholesaler operated using the same risk management strategy that business schools taught as the perfect example of commodity hedging. They would buy physical silver from mines or recyclers, then immediately sell an equivalent amount of paper silver on the COMEX futures exchange to lock in their profit margin regardless of price movements. This elegant financial architecture allowed refiners to focus on their core competency, transforming raw doré bars and ore concentrate into investment-grade products, without gambling on price fluctuations that could bankrupt them overnight. The mathematics were beautifully simple. If physical silver prices rose, they made money on inventory appreciation, but lost money on their short futures position. If prices fell, they lost money on inventory depreciation, but made money covering their shorts. Either scenario produced the same result, a steady refining fee while staying perfectly delta neutral to price risk. For 30 years, this system had weathered every storm the precious metals markets could generate. It survived the Hunt Brothers silver corner in 1980, the tech crash of 2000, the financial crisis of 2008, and the sovereign debt crisis of 2011. During each episode, silver prices moved violently, but within parameters that the hedging mathematics could handle. Even during the most extreme volatility, daily price moves rarely exceeded $3, and weekly ranges stayed within predictable bounds that allowed margin calculations to function normally. The system worked beautifully when silver moved 50 cents per day during normal market conditions. It functioned adequately when volatility increased to $2 daily during crisis periods that lasted days or weeks. But when silver began moving $4, $5, and sometimes $6 per session, rising from $55 to $60.30 in less than 72 hours, the mathematics of hedging transformed from risk management into a financial suicide mechanism that destroyed balance sheets faster than tsunamis destroy coastal villages. I called Wolfgang at Heraeus Precious Metals in Germany to understand exactly how the hedging mechanism had broken. "Margin calls," he explained with the weary resignation of someone who had been awake for 36 hours straight. "We hold 10 million ounces of physical silver in our vaults, but that metal is tied up in the refining process. Meanwhile, our short position on COMEX is losing 20 million euros per day as prices rise. The cruel irony was that Heraeus was technically solvent. Their physical silver holdings were worth more than their paper losses, but they were catastrophically illiquid. COMEX demanded cash margin payments immediately as their short positions moved against them, but their assets were literally melting in furnaces and couldn't be sold until the refining process completed in 2 weeks. The exchange doesn't care that we own the physical metal, Wolfgang continued. They want 50 million euros wired to their account by tomorrow morning, or they'll liquidate our position. Where do we get 50 million euros overnight when our assets are sitting in molten form? The answer was simple and devastating. They couldn't. So Heraeus, along with every other major refiner globally, made the only rational decision available to them. They stopped buying raw silver from mines, which meant they stopped producing refined bars, which meant dealers couldn't restock inventory, which meant retail investors couldn't buy physical silver regardless of how high they were willing to bid. By noon on December 11th, the supply chain breakdown had cascaded through every level of the silver distribution network like a financial contagion designed by Murphy's Law. Refineries couldn't hedge new purchases, so they stopped buying. Wholesalers couldn't source new inventory, so they stopped selling. Dealers couldn't restock shelves, so they suspended operations. The price signal that was supposed to bring supply and demand into equilibrium, 62.30 per ounce, had instead triggered a complete market failure that left buyers with infinite cash competing for zero available metal. It was economics in reverse, a feedback loop that pushed the system further from equilibrium with each passing hour. I started calling major industrial silver users to understand how they were responding to the supply paralysis, and their desperation painted a picture of corporate panic that extended far beyond retail investors and coin collectors into the heart of American manufacturing. Samsung's procurement team had been trying to secure 2 million ounces for their solid-state battery production lines and couldn't find legitimate sellers at any price below $90 per ounce. Tesla's Gigafactory in Austin had exactly 3 days of silver paste remaining before their solar panel assembly lines would cease operations entirely. We've called every distributor from London to Shanghai, plus mining companies in Mexico, Peru, and Canada, explained Maria Santos, head of materials sourcing at First Solar, her voice carrying the exhaustion of someone who had been working 18-hour days for a week straight. Everyone says the same thing. Check back in 3 weeks, maybe 4, possibly longer, but our production can't stop for 3 weeks. We've got Department of Energy contracts, utility delivery commitments, penalty clauses that trigger if we miss schedules. The industrial users were confronting a crisis that retail investors couldn't begin to comprehend. When a coin collector can't buy silver eagles, they experience disappointment and maybe some investment FOMO. When a solar manufacturer can't source silver paste, their assembly lines shut down within days. Workers get furloughed indefinitely, and corporate survival becomes questionable as penalty clauses worth hundreds of millions of dollars begin triggering across multiple contract obligations. General Electric's renewable energy division was facing production delays that would cascade through their entire supply chain and potentially breach commitments to wind farm developers across the Midwest. Apple's iPhone manufacturing was threatened because they couldn't source enough silver for the lightning connectors and internal circuitry that required precisely specified silver alloys. Even seemingly unrelated industries were discovering silver dependencies they had never considered problematic until the metal became unavailable at any reasonable price. The automotive sector was experiencing particular distress because electric vehicle production required silver for charging infrastructure, battery management systems, and the high-voltage switching equipment that prevented batteries from becoming incendiary devices. Ford's Lightning truck production line in Dearborn had enough silver inventory for exactly 11 days of manufacturing before they would be forced to halt operations and send workers home indefinitely. This industrial desperation was driving a shadow market that operated entirely outside traditional distribution channels. Companies were calling mining executives directly, offering premiums of $30 and $40 per ounce above spot prices for immediate delivery of unrefined material. They were willing to pay massive transportation costs to fly silver ore from Peru to processing facilities in Asia, bypassing the paralyzed Western refining network entirely. The arbitrage opportunities were enormous and completely untradeable. Silver was effectively trading at 60 Tau 30 on paper, while industrial users were paying 90-95 for immediate physical delivery. But these transactions were happening through private agreements between desperate manufacturers and opportunistic miners, invisible to public price discovery and unavailable to ordinary investors. I realized that the spot price displayed on financial terminals had become a fiction. a number representing the value of a 5,000-ounce bar that might not exist, traded by algorithms that had no connection to physical reality. The real silver market had migrated into corporate boardrooms where procurement managers negotiated survival deals that bypassed exchanges entirely. The psychological impact on retail investors was devastating and completely predictable, creating frustration that would persist long after prices normalized. They were watching silver prices reach levels they had dreamed about for years, yet couldn't participate in the rally because dealers had no inventory to sell at any price. Every precious metals forum and social media channel erupted with frustrated posts from people who had waited decades for this moment, only to discover that money couldn't buy what simply didn't exist. "I've got $100,000 sitting in my checking account ready to buy," one investor posted on Reddit's Wall Street Silver Forum. Called 15 different dealers from coast to coast. Everyone says they're completely out of stock or not accepting new orders. How is silver trading at $62 if nobody will actually sell it to me for $62? The question perfectly captured the surreal nature of a market where posted prices bore no relationship to actual transaction possibilities. Similar stories flooded precious metals forums across the internet. Retirees who had planned to convert 401k rollovers into physical silver found themselves holding cash while watching their purchasing power erode in real time. Small business owners who wanted to diversify into precious metals discovered that the window of opportunity had slammed shut just as they were reaching for the handle. The disconnect was creating a dangerous psychological precedent that would persist long after the immediate supply crisis resolved itself. Retail investors were learning harsh lessons about the difference between financial markets and physical commodity ownership. The people who already owned silver before the crisis could enjoy watching their net worth increase, but newcomers discovered they were locked out of a market they could observe but never access. By December 13th, I was tracking force majeure declarations from dealers who couldn't fulfill accepted orders. These weren't scams, but legitimate businesses with decades of successful operations, like Liberty Coin in Pennsylvania and Gainesville Coins in Florida, suddenly unable to source inventory from suppliers. Monument Metals faced the most complex situation, having accepted $40 million in pre-orders before the collapse. Their legal team struggled to determine whether force majeure applied when customers had confirmations, but delivery dates were pending. Insurance policies covered theft and disasters but excluded market volatility. The larger dealers were handling the crisis more strategically, but their solutions revealed how completely the traditional business model had broken. Instead of selling silver they didn't have, they were offering pre-order arrangements where customers could pay today for delivery in 60 to 90 days, assuming supply chains normalized by then. These pre-orders represented enormous financial risks, disguised as customer service. Dealers were essentially accepting unsecured loans from customers in exchange for promises to deliver silver at prices that might be completely disconnected from future market reality. If silver reached $100 per ounce by March 2026, customers who pre-ordered at $65 would receive extraordinary value while dealers faced catastrophic losses. The government response was predictably bureaucratic and completely ineffective. Treasury Secretary Yellen issued statements about monitoring conditions and ensuring fair trading, as if the crisis stemmed from regulatory violations rather than mathematical impossibilities in hedging systems. The CFTC announced investigations into market manipulation, apparently assuming shortages resulted from scheming rather than industrial demand overwhelming supply. Fed economists published analysis suggesting constraints were temporary, their models assuming mines could expand like factories, rather than geological operations requiring years of development. I realized that policymakers were applying conventional economic thinking to an unconventional situation where normal price mechanisms had been completely replaced by physical constraints that couldn't be overcome through monetary policy, regulatory intervention, or diplomatic negotiations. You can't print silver ounces through quantitative easing, and you can't negotiate with geological reality using trade agreements or currency swaps. The international implications were becoming increasingly serious as countries recognized that silver shortages threatened their green energy transition plans. China immediately banned silver ore exports, forcing international buyers to compete for refined metal in an already constrained market. Mexico imposed licensing requirements for silver exports, effectively prioritizing domestic battery manufacturers over foreign buyers. The European Union activated emergency trade protocols, negotiating bilateral agreements with Canada and Australia to secure silver supplies for their automotive and renewable energy industries. But even these diplomatic efforts couldn't create silver that didn't exist or restart refineries that couldn't hedge their operations. By Christmas week 2025, I was watching the emergence of a two-tiered global silver market that would persist for years beyond the immediate crisis. Tier 1 consisted of integrated industrial operations that controlled silver from mine to finished product, insulating themselves from supply chain disruptions through vertical ownership structures. Samsung's partnership with Hecla Mining in Idaho represented the future of strategic material sourcing. Rather than buying silver on spot markets, Samsung was financing mine expansion in exchange for guaranteed delivery at fixed prices, eliminating both supply risk and price volatility from their manufacturing costs. Tier 2 encompassed everyone else: retail investors, small manufacturers, jewelry companies, and financial speculators who discovered they were competing for leftovers in a market where the biggest players had secured supplies through private arrangements that bypassed public exchanges entirely. The price differential between these tiers reached extremes that made arbitrage impossible despite enormous spread opportunities. Retail silver coins were trading at $85–90 when available, while industrial contracts were reportedly settling at $95–100 for immediate delivery, yet individual investors couldn't access industrial markets, and industrial users couldn't substitute coins for bulk metal. I started receiving calls from mining executives who were grappling with entirely new business realities as traditional customers disappeared and new buyers emerged with different requirements and risk tolerances. Instead of selling to refineries for processing into standard products, they were negotiating direct supply agreements with battery manufacturers and solar companies that needed silver in different forms and purities. The whole intermediary layer is disappearing, explained Tom Rodriguez, CEO of a junior silver miner in Nevada. Tesla doesn't want London good delivery bars. They want silver powder with specific particle size distributions delivered directly to their gigafactory. We're becoming a specialty chemical company instead of a mining operation. This vertical integration trend was eliminating the commodity aspects of silver trading and transforming it into an industrial materials market where specifications, delivery timing, and supply security mattered more than price optimization. The financialization of silver through ETFs and futures contracts was being overwhelmed by industrialization, driven by technology companies that needed physical materials for manufacturing. As I concluded my analysis in late December 2025, the supply chain crisis had evolved from a temporary operational disruption into a permanent structural transformation that fundamentally redefined how silver moved from mines to end users across the global economy. The sophisticated intermediary network of refineries, wholesalers, and dealers that had efficiently distributed silver for over a century was being replaced by direct relationships between producers and industrial consumers that prioritized supply security over cost optimization. The old system had been built around financial efficiency, using leverage, hedging, and just-in-time inventory management to minimize capital requirements and maximize return on invested capital. Companies throughout the supply chain operated with thin margins, minimal inventory, and extensive use of financial instruments to manage price risk. This approach worked beautifully during periods of normal volatility and steady demand growth, but proved catastrophically fragile when confronted with the industrial demand explosion that began in 2024. The new system emerging from the crisis prioritized supply security over financial optimization, with industrial users willing to pay significant premiums for guaranteed delivery and long-term contract arrangements that eliminated sourcing risk. Samsung's agreement to finance Hecla Mining's expansion in exchange for 10 years of guaranteed silver delivery represented the future of strategic material sourcing, where manufacturers became vertically integrated commodity companies to ensure access to critical inputs. Tesla announced similar arrangements with 3 different mining companies across North America, effectively becoming a minority investor in silver production to secure supplies for their battery and solar panel manufacturing. Apple disclosed that they were financing recycling facility construction to recover silver from discarded electronics, creating closed-loop supply chains that reduced their dependence on mining production that they couldn't control. The $62.30 price level would be remembered not just as a number on a chart, but as the precise point where traditional commodity distribution systems encountered the physical limits of financial engineering and discovered that mathematical elegance couldn't overcome geological scarcity. Hedging strategies that had worked perfectly for decades in stable markets became liability amplifiers when confronted with volatility that exceeded every historical parameter by orders of magnitude. The retail precious metals market survived the crisis but emerged fundamentally changed, with permanently higher premiums, significantly longer delivery times, and more stringent purchasing requirements that reflected the new reality of constrained supply and industrial demand competition. The casual silver investor who could once buy coins impulsively during lunch breaks discovered that precious metals ownership now required the same advanced planning and strategic thinking as acquiring any other genuinely scarce resource. What had started as a technical breakdown in commodity hedging mathematics triggered a permanent restructuring of global silver flows that would influence pricing, availability, and allocation patterns for decades to come. The fundamental question wasn't when the supply chain would return to its previous normal operation. It was whether normal had been permanently redefined by the collision between financial engineering and physical reality in ways that couldn't be reversed through policy intervention or market manipulation.